Welcome to Intermediate Accounting Chapter 7. In this chapter, we're going to be talking about cash and receivables. This could be a little bit of a sigh of relief compared to some of the recent chapters that we've gone over. But let's go ahead and jump into the first section of this chapter. So we see cash and cash equivalents show up on the balance sheet. What is that talking about exactly? So cash is pretty easy. It refers to money in the form of currency or deposits that a company can access immediately. So examples of that are coins, paper money, of course, but also checking accounts and undeposited checks. All of that you'll see listed out under cash on the balance sheet. So when we talk about cash, it's not just what's in the register, but it is also what is in the bank that you can get out immediately and undeposited checks. Cash equivalents are a little different. They're going to be listed right under cash if a company has them, but they're going to include short-term investments as long as they're highly liquid. They can be turned to cash really quickly in at least less than 3 months. And they also have to be very little risk. So if you have this in cryptocurrency, that's not going to be able to count as cash equivalents because it's so volatile. It goes so different, so unpredictable constantly. Good examples of cash equivalents would be treasury bills. So that's going to be where you got an investment with the government. Money market funds, similar to a savings account, just a little harder to get the money out sometimes. And then commercial paper, another investment that you can quickly get your money out. So all of those are examples of cash and cash equivalents. So when it comes to cash, or really anything when it comes to how your company's working, it's really important to have internal controls. So we're going to really focus on internal controls with cash in this chapter because cash is one of the things that we need to have the strongest internal controls over because there are so many opportunities for fraud and error. So internal controls promotes operational efficiency. We want our company to operate as efficiently as possible. So they can help to do that. Make sure we're getting rid of wasted time, wasted material. We want to be using our time as efficiently as possible. They can also enhance reliability and accuracy of the accounting data. We want our accounting data to be as accurate as possible. It doesn't mean there will never ever be an error, but we want it to be as accurate as possible because it's going to be used to make decisions. So we want to make sure we have internal controls to help support that goal. And it will definitely minimize errors and theft or any kind of fraud if we have good internal controls in place. So a few things that are going to back up that internal controls, one of them is SOX, Sarbanes-Oxley Act. Now, this was enacted in 2002, so over 20 years ago. It's to protect investors by improving the accuracy and reliability of corporate financial reporting. So whenever you want to invest in a company that's on the stock exchange, they have to abide by SOX, by Sarbanes-Oxley Act. And that just helps to make sure that all the companies that are on the public stock exchange are going to be meeting these standards. It was created because of major accounting scandals. You may have heard of Enron or WorldCom, two of the biggest scandals that resulted in lots of people losing their jobs, losing their retirements. It ended up in a lot of people being put into prison. And this was what led up to Sarbanes-Oxley Act because there were not enough internal controls in place. It requires stricter internal controls, greater accountability from company executives, and stronger oversight of auditors. Back when this happened with Enron, I mean, the auditors, they had stake in the company. They're like, we're going to be in cahoots here and make sure we can get away with this. But now they cannot have that. Auditors have to be completely independent in order to issue an opinion because it's not right for the auditor to have stake in the company, for them to have some reason they want the company to succeed. So Sarbanes-Oxley Act has put that into place. The Committee of Sponsoring Organizations, COSO, has developed a widely used framework for designing, implementing, and evaluating internal controls. It really helps companies with their internal controls. Its goal is to help organizations improve their systems to prevent fraud, ensure reliable financial reporting, and comply with laws and regulations. So you don't have to completely start from scratch as a company. You can use this committee of sponsoring organizations in order to help with that internal controls, in order to know how to put that into place. So let's talk about some procedures to protect cash. First, we're going to focus on protecting our cash receipts when our company has money come in. So, several steps we want to follow here. First, we receive the cash. This could be cash or checks. We've got one person who is collecting the cash. It could even be two. They're maybe checking the mail together, they're collecting it from customers, but we have a separate duty of people or a person who are specifically collecting the cash and checks. They're not depositing, however. Then step two, we're recording the cash. We have a different person record the amount received in the accounting system. So we want to have at least two separate people here. This is separation of duties. The more people that we can have do something throughout this process, especially with cash, it can prevent fraud and errors. Step three, a third person is responsible for preparing and making the bank deposit, separate from steps one and two. By the way, this should be done every day. Bank deposits should be done every day, whether they're checks or cash. This will help reduce risk. And our fourth step is reconciling the accounts. This is where we make sure that our bank statement has the same amount as our accounting records, and we see where there's any differences there. And that needs to be a fourth person. And all of these steps could have multiple people. If it's a huge company like Apple, they're going to have lots of people recording or receiving cash, lots of people recording cash, lots of people depositing it, and lots of people like reconciling it. It's not just going to be one each. But the goal here is to separate these duties as much as possible so they're not overlapping. The really tricky part comes in when it's a small company, because maybe you've only got 3 employees. And how are we going to separate this out? Well, if that's the case, we still want to aim to separate these duties as much as possible and at least have at least 2 pairs of eyes on each of these to prevent fraud and error, because we're all human and we are going to make errors. Now, what about cash disbursements, where we are paying our vendors? We want to make sure we are requiring authorization for payments. And if it's a large amount, it needs to have dual signatures. So maybe your company says any checks that we're paying over $5,000 has to have the signature of the chief accounting officer and the chief financial officer. It needs to have both those signatures or something along those lines. So we need to make sure there's authorizations for this. Using pre-numbered checks or digital records, not using cash to pay people, because when you pay people with cash, I'm telling you, I have worked in departments like this where, the vendor comes back and says, hey, you never paid for this. You never paid this invoice. And I'm like, actually, I paid it with check number 2431, and it looks like that you deposited it in your bank account on August 24th. Oh, you're right. We did deposit a check 2431 or whatever for that amount. You know what? We put that under the wrong customer payment. I'm telling you, this stuff happens all the time. So you need record of it. Cash does not give you the record that you need. So that's really important with cash disbursements. Again, segregation of duties. The more we can split these duties up, the better. I worked at a small company that gave me way too much access of all these duties that need to be separated. And I went to the owner and I said, look, I'm not going to commit fraud, but I certainly will make errors, and I need someone else's eyes on this. Plus, if anything were to happen where some other employee got their hands on these things, it's going to look bad on me. So I want there to be several people that have to touch these things so that it's not all going to come back on me. And then you have to reconcile those bank accounts regularly, just like we saw in our cash receipts as well. And yeah, we did put into place in that company where, okay, at least one other person is going to start helping out before I pay all these checks. Someone else has to sign them, because I'll tell you what, the owner gave me a stamp with his signature. Hey, you can put in new vendors. You can record the invoices. You can then write the check for those and then send those out with my stamped signature on them and mail them out. all of that was my job. No one else checking after me. And I'm like, look, we need to separate these some just for, having some internal controls. And then, you know what we found out? Okay, I'd pay a check, but someone else would look over them first. And this lady would say, wait a second, don't we pay this vendor with credit card? I said, you're right. They automatically take that with our credit card. I was about to pay them a second time. Sure, we would have gotten our money back. They would have given it back, but it would have been a whole thing. It would have wasted our time. It would have wasted their time. So just having one more set of eyes on something can help prevent those type of errors. All right, so let's talk about restricted cash. You can probably guess what restricted cash is. It is set aside for a specific purpose. It cannot just be used for general operations. It's not like this cash is there to pay employees or pay vendors or whatever we need to do. No, it's going to be set aside for something specific. Repaying a loan. Maybe this is a loan to the bank. Maybe these are bonds that you're going to have to repay. Covering a deposit. So just think in your personal life, maybe you are setting aside restricted cash. I can't use this for paying my rent, can't use this for vacation or my car payment. This is set aside to have money ready for a down payment for a home. That would be like restricted cash in your personal life. Could also be contractual obligations. So that's what we're going to look at next here. Contractual obligation that requires you to have restricted cash. That would be a compensating balance. So this is a little bit interesting here. This is where there's a minimum amount of cash that a borrower is required to keep in a bank account as part of a loan agreement. So the bank says, sure, we're going to lend you, $50,000, but you have to keep $20,000 in our bank in a deposit. So this is going to help the lender reduce their risk. So one, it can make sure that they are that they have the money there. So if you didn't make the payments, they could come after you. And two, it will help them to make sure you're not just going to disappear. I borrowed $50,000 and they never saw me again. I fled the country. No, instead they'd say, you've got $20,000 in our bank. I know you're not going anywhere. So it helps to lessen the risk. Let's look at our last example with sunset sound systems. In chapter 6, we saw all these sunset sound systems examples. And then I'm going to introduce you to a whole new company that we'll be using in this chapter. Can you even wait? How excited are you? We'll do that in this video. Okay, so this company took out a $100,000 loan from their bank as part of an agreement. The bank requires them to keep a compensating balance of $10,000 in a non-interest bearing account for the life of the loan. Okay, so what's the amount that they actually are borrowing? They're really borrowing $90,000. They said they're getting $100,000, but they have to keep $10,000 in the bank. So they're really only borrowing $90,000. How should that $10,000 compensating balance be reported? As restricted cash. On the balance sheet, it's going to be restricted cash. It would be current if they're going to pay this loan off and they don't have to have that restricted cash in the next year. But if it's going to go past a year, it would be in the non-current section. And then why would they require a compensating balance? Well, we just talked about this, to reduce risk and ensure the borrower maintains a relationship with the bank. So it helps to lessen that risk for these reasons. Now let's jump into accounts receivable. So accounts receivable represents the money owed to a company by its customers for goods or services delivered on credit. We know it's an asset showing the amounts that the company expects to collect in the near future. You already know what accounts receivables are, right? We've talked about this for so long. This is going to be the current section of the balance sheet. We know that this is created anytime we see that we made a sell to a customer and it was on credit. That tells us they didn't pay cash right away. Instead, that tells us that this is going to be an asset that is really like an IOU. The customer owes us later on. So things to note, trade discounts. So this is a reduction from the list price for a customer based on a percentage. So a lot of times this is something like a large quantity is sold to a customer, and as an incentive for them to go ahead and buy that large quantity from us, we give them a trade discount. So okay, if you buy 10, you have to pay 100% of the cost, but if you buy 1,000 of these, we're going to give you an 8% discount or something like that. So they're like, okay, well, I should go ahead and buy 1,000 from them to get that discount. We all like discounts, right? I know I do. Then there's sales discounts. This is where there's a reduction paid by the customer for an early payment of an invoice. So this is an incentive to collect payment early. I know that when I've worked for companies in these departments, we see a lot of customers that if they're offered a discount, they will pay earlier. They'll pay in that short time period in order to get the discount, and we would do the same. If someone offered us a discount, my boss would say, yes, go for it, pay early. We want every discount we can get. So we're going to look at an example. But first, drum roll. Our new case study is Hillbilly Hairdressers, looking snazzy since the county fair. Do you want this guy cutting your hair? I mean, maybe he's competent, but the scissors are a little large. All right, so better than Edward Scissorhands, though. Okay, so let's look at our first example with Hillbilly Hairdressers. They offer credit customers a 2% discount if the sales price is paid within 10 days. Any amount not paid within 10 days, due in full in 30 days. So remember these payment terms. It's, as you see in red here, 210 net 30. That means 2% discount if you pay in 10 days. Otherwise, you have to pay all of it in 30 days. So on August 12th, my birthday, 2026, Hillbilly sold merchandise at a price of $20,000. Those are some fancy scissors. So there's two different methods we can use. We have the gross method. If we use the gross method, this is where we say, you know what, they're probably not going to take the discount. That's kind of what we're assuming. So we debit accounts receivable for the full amount they owe, and we credit sales revenue for the full amount. The net method says, no, I think they're going to take the discount. So we go ahead and take into consideration that they are going to take the discount. So we debit accounts receivable for $19,600, which is the 98%. If they got a 2% discount, they're only paying 98% of the $20,000. So for the $19,600, and we only credit sales revenue for that amount as well. All right, so let's say that on August 16th, the customer paid the $19,600. They took that 2% discount. So if we had used the gross method and we had assumed they weren't going to take it, we would now be debiting cash for just the $19,600, but we have to credit the accounts receivable for the full $20,000. Because if we only credit accounts receivable for $19,600, it's going to have a $400 balance in there, making it look like somebody still owes us when they don't. We gave them a discount. So you have to make sure you credit accounts receivable for the full amount that you debited it for. The difference, the sales discount of $400, is a debit that will reduce our net revenue. So anytime we have the word net, we know there must have been something taken out from it. Whether it's your paycheck, you've got your gross pay, you're like, wow, I get paid so much. And then they take out taxes and insurance and 401k and union dues. And then you get your net pay and you're like, what? Are you kidding me? Same thing here. We have our sales revenue, but then if there's any kind of discounts, it's taken out and it reduces how much we actually have in net revenue. Now for the net method, as long as they took the discount, then we say, okay, we got cash of $19,600. We already expected they were going to pay us in time. So we just credit our accounts receivable for the same amount that we had debited it for $19,600. Now, if they did not pay within the 10 days, then the gross method, we would have just shown cash for $20,000, accounts receivable for $20,000. The net method, we would have shown that we had cash come in for $20,000. Accounts receivable, we're only going to credit for the amount that we put in there, the $19,600, and the difference we're going to put at a discount forfeited that they didn't take. So let's look at the results with these two methods. The results are in, yay! So with the gross method, the way we just saw it, they had $20,000 in sales revenue. Like, yeah, sure, they're not going to take the discount. But then when they did take it, we debited sales discounts, which reduced our net sales revenue to $19,600. In the net method, they just kept the $19,600. They didn't have any sales discounts. Then we have this little 400 here popping up under the net method. That's just if they wouldn't have paid it in time, we would have added 400 to our sales revenue, which would have increased our net sales revenue. But since that didn't happen, I didn't change the total. But if we did, we would have seen 19,600 under sales revenue. We would have added 400, and then our sales revenue would have been 20,000. So just kind of showing you what it would have looked like if they would not have paid within the 10 days and taken the discount. So just remember, when you run a company, if you offer the sales discount, you're likely to get the cash sooner, and then you can use it for something else. And if someone offers you the discount, I say take it if you can, because it's great if you can pay less for any kind of product or service. All right, make sure you subscribe, because we're going to have many more videos for this chapter, and we got all the way through chapter 21 in intermediate accounting. So let's walk through these together.